All right, in this lesson, we are going to give you a broad overview of what financial statements are and some of the characteristics that go into financial statements. And then after we do this, in the next couple of videos, we'll actually break down each financial statement individually. So this is kind of that introduction to the next couple of videos in which we're talking about each of those financial statements. So as we get started, this first question is kind of what we're trying to answer. So when a company provides financial statements, so we've been talking about this the entire last couple of videos, what are these financial statements? So these financial statements to external users, what are we really talking about? And so that's what we're going to cover here. Now, financial statements are the financial statements a company provides to their external users are considered broad-based financial statements. And if you remember, we said that they're broad-based because we don't want to give too much detail. We want them to be informative, but we don't want to give too much information so that competitors can use that against us as a competitive advantage. So in the last couple of lessons, I've talked about how, we may not want to expose what our cost of goods sold is, so the cost of the goods that we're actually selling to someone. So example that I used was this tape right here. This might cost me $2 and then I sell it to the consumer for $3. I might not want my competitors knowing how much this costs me because I might actually have a competitive advantage. So they're pricing this at $3 thinking that they have to match what we do, but what they don't know is they're buying it for $2.50 and I'm buying it for $2, which means I'm making 100% more profit than they are. So that's a competitive advantage. We don't want to expose that at the end of the day with these financial statements. So they are broad-based financial statements just to give external users, just enough information to make informative decisions, but not enough to actually give away our secrets on how we're doing with our finances. So that's what we're doing with financial statements. Now, there are 4 basic financial statements. So when we say financial statements, we're talking about this complete set of 4. And like I said, in the next couple of videos, we'll explain each one individually. The first one we have is the income statement. So the income statement summarizes the income or the profit and loss of a company. And so that is the net income equation that you just learned in the last lesson. Then we have the statement of retained earnings. The statement of retained earnings has to do with how much the company retains at the end of the day of the profits rather than distributing them to the shareholders. From there, we have the balance sheet. The balance sheet tells us really what the company owns and who really owns them, or what the company controls or has and who owns them, whether it's the shareholders or the lien holders, the debt, the people that were extending debt to the company, who really owns all of these assets. And so that's the balance sheet. And then the statement of cash flows, the way that I like to think about the statement of cash flows, it's like a bank statement. It shows the ins and outs of a company's cash, and it summarizes them over a period of time. So the statement of cash flows is really important because without cash, a company doesn't really do well at the end of the day. Now, there is an order to this when we start preparing them, and you'll learn how to prepare them in this course, but there is an order to preparing these financial statements. The first one that we start off is with the income statement. So we actually prepare the income statement first because we need that profit number to be able to prepare the statement of retained earnings. So we can't do the statement of retained earnings without the profit because we need to know how much profit the company has, and then of that amount, how much is being distributed to shareholders and how much is actually staying with the company in the form of retained earnings. Then after we do that, we can then prepare the balance sheet. Now we need the statement of retained earnings because we need to know what that ending retained earnings is in order to update that on the balance sheet. And so we need to do the statement of retained earnings first to get that ending number. That ending number flows through to the balance sheet. Once we have the balance sheet, then we need to do a reconciliation document. A reconciliation document just basically means we're going to reconcile the numbers. We're going to agree the numbers on the balance balance sheet. In this case, we are agreeing the cash amount. So if we say that we have $20,000 in cash, we're going to use a statement of retained earnings to prove that we have $20,000 in cash. So if we started the year with $10,000, how do we go from $10,000 to $20,000? Well, we got cash from sales. Maybe we borrowed $5,000. Maybe we had investors kick in $1,000. So the statement of retained earnings helps us reconcile, helps us balance the number that gets reported on the balance sheet. So that's kind of the process here when we talk about preparing financial statements. Always start with the income statement, then flow to the retained earnings, then to the balance sheet, and then finally the statement of cash flows. You've got to do it in that order. If you do it in any other order, it will not work. So just know that. Now, when we prepare financial statements, we kind of talked about this in another lesson, but when we prepare financial statements, we can prepare them annually, so only once a year. We can prepare them semi-annually, twice a year, so every 6 months we'll prepare a new one for the last 6 months. We can prepare them quarterly, every quarter. Now, quarterly is important because this is for those that are public companies. So public companies will need to report quarterly because of the Securities Exchange Commission has said that they have to report quarterly to their investors. And so quarterly is that. We also might have monthly. So for instance, I own a rental property. In my rental property, I actually produce monthly financial statements. The reason that I do that is I want to see what my profit is for the month, that prior month, owning that rental property. And it's not a lot at the end of the day. It's kind of the same information because the rent amount is the same, the management fee is the same, some of the other expenses are the same. But what's interesting is that during the summer I have lawn care, so I actually pay a lawn care person to cut the lawn for my tenant, and so that's going to change with the seasons. My property's in Kansas, so it snows there, so there is no growth of the lawn during winter months, so I'm not even paying that, which is giving me a higher profit margin. So I'm preparing it monthly so that I can see exactly what cash flows coming in and out, but you don't need to do that. So again, we can prepare financial statements monthly because that's what we need to make decisions later on. So the most common are obviously quarterly and annually, and this is dictated by the Securities Exchange Commission. They are the governmental agency that oversees public companies. And so because of federal regulation, these public companies have to issue an annual statement and a quarterly statement, and that's what we have here. Now let's talk about time period. So we talked about all of these financial statements, but when we report the financial statements, what time period are we looking at? So think about your bank statement. Your bank statement, what time period is that? Well, it's usually for a month. So they will have the start of the month, which is maybe January 1st, and goes all the way to January 31st. And so that is the time period for that statement. Well, just like your bank statement has a time period, all of these financial statements have a time period as well. And it all is going to be dictated on when the company's year starts. Okay, so that's kind of really the question is. Now, normally you would think, okay, the year starts on January 1 and goes through December 31st. But for companies, they actually have two choices. They can use what we call the calendar year, January 1st through December 31st, or they can use something called a fiscal year. A fiscal year is a little bit different than a calendar year. So when we talk about calendar year, the year ends on 12/31 of every single year. Makes sense, just like your bank statement ends at the end of the month. Or if they give you an annualized statement, sometimes they do, they'll annualize all of your expenses and give you one summary report for the year that ends on 12/31. But we also have this new one here called fiscal year. Now, fiscal year basically means that your books end on any date other than 12/31, 20x whatever year, okay? So any date that ends on any year that ends on a date other than 12/31 is called a fiscal year. Now, the decision of time period is usually influenced by a company's business cycle. So here's an example of why a company might use a fiscal year rather than a calendar year. So if you think about the holiday season, so a retailer like Target, what's happening at 12/31 at the end of the year? Well, they've got this rush of people that come in to buy gifts for their family, to decorate their home. It's probably the biggest time of the year where those companies go into black territory, profit territory. And so they're doing a lot of business, right? 12/31 comes, and then we have to close the books. So in January, we're going to close the books for the prior year. But what's happening in January? Well, returns, right? So people will come in before December 25th, buy all of these things, and then over the next 30 days, because the return policy often is 30 days or 90 days, within those 30 days is when most of your returns are going to happen. Well, 30 days after December 25th is January 25th. So if we really think about it, they're still going to be very busy up until the middle of January processing returns. And so for a company like Target, they don't want their year to end on 12/31 because they're still busy processing all the returns. So what they want is they want their year to end when it's the slowest. Well, for retailers, the slowest is the middle to end of January through March and April before the summer months, specifically Easter. And so if that's their slowest time, that also means that the accounting department has time to catch up from all of those sales and returns that happen between November and January. So for those retailers, they may put their fiscal year ending on January 31st rather than December 31st to give them more slack. And so they will close their books on January 31st of each year rather than on December 31st. Can they do that? Yes, they can. So it seems a little odd because we're so ingrained in our personal finances that the end of the year is 12/31, but for a company like Target or Walmart, their end of the year may be January 31st or February 1st because that's the end of their business cycle and they get into a slow time. The slow time is when they can catch up on all of these inventory counts or preparing financial statements. So we generally pick what's best for a company. Now, a small mom and pop shop is probably going to do calendar year 12/31 because it doesn't matter to them. But for a big organization has a lot of moving parts, December 31st may not be the best. Another example is if you are in the summer gear type of business, obviously you don't want to have your end of the year in the summer months. Maybe you want it in the winter months. So maybe 12/31 works for you, or maybe just after summer is over. So maybe October 30th or 31st would be better to close because then you have 3 or 4 months to close your books before you start thinking about the summer season in January and February. So again, thinking about time period of financial statements, a company gets to choose, and they usually choose when they first start. So when they first start, they choose either they're going to be a calendar year or fiscal year. So remember that as you go through examples, what's the end of the year? Is it the fiscal year or is it the calendar year? Oftentimes it's going to be calendar year, but you should know that fiscal year is an option. So that is a look at the financial statements. Those are the 4 financial statements to have and some of the characteristics that go in to the financial statements. In the next few lessons, we're going to talk about each of these financial statements separately so that you have a good understanding of how these financial statements work and what goes on them at the end of the day so that you as a business manager can make better decisions. So I hope you enjoyed this lesson and we'll see you in the next video. Hey guys, it's Patrick. Before you skip ahead to the next section, just wanted to come on here and tell you to not forget to like this video and maybe share this video with someone that you know that would get a lot out of this lesson. Maybe a classmate that you know. This would be a great way to introduce them to this channel. So share this video with them, maybe your mom or your dad, someone, so that they know that you're really learning accounting topics here on YouTube and you're not just playing cat videos over and over again. Now, if you want to help us grow this channel, what would be great is if you press the subscribe button and maybe even turn on the notification bell if you want to get alerted the next time we upload a video to this channel. And put in the comment section below, what did you eat last night? it would be so weird for people to come and look at the comments, but what did you eat last night? I might throw in a comment after you if you put that in the comment section below. So do that now. What did you eat last night? All right, so enough of the fun stuff. Hope you enjoyed this lesson, and we'll see you in the next video.